Still like this barbell approach. Explain exactly what that means and how that can help investors navigate through a period where we may slow, we may not slow, we may learn to live more quickly with something that hopefully burns itself out faster than we saw. Maybe we're seeing positive signs like that, but how do you structure the portfolio that way?
Yeah. Well, it's good to see you, Joe. Honestly, it's all about diversification, right? And it's having some economically sensitive companies, some cyclical companies, some reopen names, because those are the ones that actually haven't participated over the last several months because we've had this kind of growth scare, if you will, right? But I do believe we're going to see above trend growth in 2022. Not as great as 2021, but I think 3-4% growth is still above trend and positive, and it should help some of these companies. And I think there's an enormous amount of pent-up demand from the consumer, and I think the consumer is in very, very good shape, given wages, given jobs, even the savings rate. Although it's come down, it's still pretty elevated. So I think that's one part of the portfolio you want to have exposure to, right? So that's financials, that's industrials, that's energy, materials, that's travel, leisure. I mean, look at those TSA numbers over the weekend. 6.4 million people traveled over the weekend. So there is, as I mentioned, pent-up demand. That's the one side. The other side is total addressable market stories, right? And that's secular growth. That's AI. That's EV. That's cloud. I mean, listen to what Micron said just yesterday. All of those areas are driving better than expected results for Micron. I don't own Micron, but I own a lot of semiconductor companies because they do have end markets that are growing substantially, not just this year, but over the next several years. So you want to have exposure there as well.
So last year, or even the year before, you wanted high multiple names, didn't you? Because they were the ones that you at this point like growth, but you're avoiding those. Why? Because rates are headed up, or because you just think it's just not the right time for that? So you try to pick stocks that or companies that are sort of sexy and growers, but just not with the high multiples.
Yeah, no, I that's just not my style. And a lot of them are stay at home, and they benefited from stay at home. So I think as we reopen, and we are going to reopen, hopefully we don't have closures over this Omicron situation, but I think you want to find companies that have real earnings, right? And that their valuations are reasonable. And that's the way I invest, right? Like growth at a reasonable price. So you don't have to go for the high flyers. You can certainly find the total addressable market stories, like I just mentioned, in some more realistic valuations.
But you think something like a Cisco, which, if you talk to someone who, not new to the market, but someone that's seen the last 5 years, Cisco hasn't been the one you wish you were in. You wish you were in the ones that you just said are not your style, right? It's done okay, but you would prefer this to like trying to buy one of the high flyers on a pullback.
Yeah, I mean, look, I think you want to have a combination. I have made a lot of money in some of the semiconductor names, right? Like a Broadcom, for example, or a Lam Research or an NXPI. That's on the one hand. And oh, by the way, all of those trade about 19 times forward estimates. So they're not expensive. So those are the ones I own on the one hand. And on the other hand, I do like Cisco. And here's the reason why. Enterprise spend is going to recover. We're starting to hear about that. We heard it from Broadcom. We heard it from HPE. We heard it from Dell. And we also did hear it from Cisco. They have very good visibility. Product orders were up, grew 33%, led by 200% growth in cloud, 30% in enterprise, and 46% in commercial. I think their guidance is very conservative because they have supply constraints. Who doesn't, right? So I think at the same time, the price increases that they're putting through are going to help them in 2022. So 17 times forward with a 2.5% dividend yield. I kind of like that. Again, the enterprise spend recovery story is why I think they're going to have some tailwinds for 2022.